Thank you for inviting me here. So I'm going to talk about the role of behavioral economics in household financial decision making. I think you can, the main point from this sheet you should take away is all views are mine and nobody else's. So let me start by kind of thinking through. There is growing concern that consumers are ill-prepared to make sound decisions in an increasingly complex financial environment. Many examples come to my mind. How do you invest in your CPF? Under-participation in the retirement plans. We already heard about some of these issues. Lack of sufficient portfolio diversification. Choosing the right mortgage product that you need. Obviously, these days there is this growing issue of loan sharks. The one issue that actually caught my eye while I was working on these research issues is there was a bank in the US that was advertising that they offered 3,000 different kinds of credit cards. Now, how is a consumer supposed to choose what is the right credit card? If you look at same issue with investment products, you typically get this vast basket of investment products. How do you choose between them? So just this is a daunting task to choose which is the right investment product or right credit card offer that you could choose. So some people, as a result, have been arguing that consumers will end up making wrong choices and pay very high interest rates or fees on these things. Others have argued that, financial intermediaries may be to be blamed because they will extract huge rents or fees from their customers. We all agree that most consumers need financial education or financial literacy or financial planning to overcome of these problems. So what I will do is, what I've been spending last 15 years is trying to study these issues and come up with solutions for helping consumers make sound financial decisions. So today I will specifically touch on a few of these things. Do consumers make mistakes in choosing consumer credit contracts? This could be all kinds of contracts. I've been studying contracts from credit cards to mortgages to auto loans. I mean, a vast array of contracts I've looked at. Do people learn from these mistakes? If they learn, who are these people who are actually making the mistakes in choosing contracts? And are these mistakes widely distributed across various domains? Can I then try to help people learn from these mistakes? And what kind of learning can we do? Does financial literacy or education then work in these scenarios? So typically, I will use large administrative data sets or looking at studying hundreds of thousands of people. While I will not emphasize that in the talk, but just keep that in the back of your mind that every conclusion I'm drawing is from large amounts of data taken from banks or other sources, and then telling you what we can learn from these things. So the first thing I started looking at is a very simple choice. If I actually give this choice to most of you in this room, you'll get it right, that if I ask you to choose between two credit cards, one is a credit card that pays you an interest rate of 12% and an annual fee of $20, versus a credit card that that charges the interest rate of 15%, but no annual fee. And I then tell you, you can switch between these credit cards anytime you want. You can choose one, then realize that I can switch between the two. So the optimal choice for anybody should be that consumers expecting to borrow should obviously choose credit card 1, and consumers expecting not to borrow, they should choose credit card 2. That sounds very straightforward. I mean, there's nothing complicated or complex, especially if you actually know that I can ex post, after the fact, switch my contracts, even if I end up making a mistake in these things. Well, when I look at the data, this is the data of around 150,000 consumers I looked at. What you find is, strictly speaking, 43% of the people end up making some mistake, that they actually choose the wrong contract. So they choose the wrong credit card, and if you look at their behavior ex post, they actually realize either they should have chosen one and they actually ended up choosing two. If I look at the amount of mistake, dollar amount of mistake, as it goes higher and higher, you actually see the number of people who are making mistakes on these contracts reduces. So around 20% of the people are making a mistake of anywhere between $50 to $100 a year. Now, you might say $100 is not much, but I mean, if you're young, it can amount to significant numbers. Especially economics teaches us that we should not be making any mistakes. We are very rational agents. We shouldn't be doing this. So then, this is across consumers. Now, next thing I want to study is, do we over time then, we may make mistakes, 40% I'm telling you will make mistakes, but maybe over time I actually learn and get the right contract. Here I looked at consumers who were actually starting out a contract with a credit card company, and what happened is they ended up in the first year paying around $150 in fees to the bank. Various fees, late payment fee, overdraft fee, all kinds of fees they end up paying. But over time, consumers actually learn, and by the year 5, the fee drops to around $50, or there's 66% reduction in fees over a 5-year period. So that kind of tells me that we do make mistakes, but given enough sufficient time, we will learn and try to make less mistakes. The next question I'm concerned about is, who makes mistakes? So here's a home equity loans and lines product. This is like mortgages or equity you can withdraw from your housing. Now I want to see who are the people making mistakes. I was just plotting simply a graph of borrower age and the interest rate that you pay. Actually, this is condition mean, so I'm controlling for everything else that you can observe about the person. So this is just plotting age as a function of interest rate. And what this tells me that people who are young and old tend to make more mistakes. Okay? So this is an important point I want to make to all of you guys in the room, that this is a vulnerable group, and we care about making sure that people who are younger should not be making mistakes, or how can we overcome these mistakes. So this is not just in one product. I actually ran this analysis over 10 different financial products, and I find the same evidence. Or in other words, what I find is the age of peak optimal reasoning is around 53. So it's good news for you guys. I mean, you have a long way to go where you will actually reach the peak. But you are right now in the vulnerable age group. Okay. So why are people making mistakes? That's the big question. So the best part is that at age 20, you have the highest cognitive ability. So you guys are actually around that age and have the highest cognitive ability. The bad news is it just declines after this. This is the peak you're at. And by the time you're my age, you are at half the one standard deviation below. When you're at age 50, you're at the bottom 50th percentile of the cognitive ability. But there is rising experience with age. So experience will rise, and you will actually gain more experience using these products. So there is a sweet spot between this analytical capital declining all the way in age and experiential capital rising with age. So you can think about there is some middle age group where you will actually start making optimal financial decisions. So ideally, you want to have very high analytical capital throughout, and so you don't have to worry about it. So that's the next thing I started looking at is, fine, I am making an argument that analytical capital is important. Can we actually study that further? So I actually looked at all the men who joined the Army in the U.S., and they have to take this Armed Services Vocational Aptitude Battery Test. These are a series of tests that you have to take in math and language. And as the boys in Singapore also have to do that, you actually take a series of tests. I wanted to know, can I use these test scores to predict if you're going to make better financial decisions? So I'm going to skip the questions, but these questions are straightforward. They will ask you if you can divide 27 by 3 and take the square root of that, and you should be able to get the right answer. So the key point is, if I actually use that score to predict who will make better financial decisions, I find that people who have higher this AFQT score or this math test scores, they actually tend to get these mistakes less often. This is a simple graph showing that if you actually have higher AFQT scores, you get this eureka moment in picking between balance transfer offers on credit cards faster. So clearly, the higher math scores you have, the better off you are in making financial decisions, or less mistakes that you will end up making in your decision process. So what I've been able to show you in this quick 5-7 minutes is that around 40% of consumers may be making mistakes and choosing wrong contracts. This could be investment contracts or debt contracts. we can actually learn over time from these mistakes, and over years when we repeatedly interact with these financial intermediaries and financial investment products, we'll actually get them right. But these mistakes are widely, across domains we tend to make these mistakes. Within a person, we'll make mistakes on mortgages and auto and investment products. But we also find these mistakes are more so for the young and the old. And as people have more cognitive abilities, they will tend to make less mistakes. So young and old are more vulnerable, but if you have higher cognitive abilities, you'll actually learn faster to get away from these mistakes. So what does that bring to me? I mean, what can we take away from this? We should think about solutions. What are the possible solutions? The solutions I have is we can do something about financial education and advice. We can think about simplifying some of these contracts that financial intermediaries are providing. We can think about coming up with default options and some disclosure requirements. Now, I'll focus on financial education and advice, but I'll also talk about the other three here. So one thing we could do is we could actually require consumers to go through financial counseling. So I've studied this in detail in the U.S. and looked at two different experiments that were conducted in the U.S. that what happens if we could put people through financial counseling. And I looked at one program that was actually forcing consumers before they buy a house to actually take financial counseling classes. And I could see that they actually, their FICO scores or their credit scores improved dramatically. Their ability to buy a house went up, and the ability to not become delinquent in that house went down. So actually, financial counseling in this program and a couple other programs that I've looked at was very, very important. That I required them to go through financial counseling programs, it was very effective. How about financial advice? I mean, I think it's a great idea to provide financial advice, but I just want to caution that it is time-consuming and relies on consumer input. So while it's a good idea, but sometimes it may not be perfectly optimal. I studied a financial advice program in the U.S. where consumers went to get financial advice before they took out mortgages, and what happened is 30% of them actually went out, got the right advice, and still made the wrong decision. So not always advice will turn out good. Counseling is much better. It's repeated. We actually sit down with you. You come back again and again and again, and repeatedly you learn. But just one-time advice may backfire. You actually might take it and say, yeah, this guy doesn't know anything. I'm going to just do whatever I want to do. Okay. Maybe simplification is another solution we can think about. Just like this credit card contracts I brought up, if I simplify and just give you very simple two options, here is one option, here's another option, choose between the two, I think it's a possible solution. But sometimes things are very complex. We can't really simplify them. Towards this, I actually built a very simple calculator that we put up on the web, and we allowed consumers to be able to use this mortgage refinancing calculator. We find that it is very helpful, but still simplification by itself will not solve all the problems. How about thinking of some default options? Like if you don't choose, this is your default option. One big problem we see in retirement saving is people don't actually choose the amount of retirement savings they should put in, the amount of money they should put in retirement savings. They'll typically choose zero. Maybe 6 to 10% of their income is the right amount they should put retirement saving. So like in Singapore, they actually have a default. They'll take part of your money and they will put it in retirement saving around 20%. So in other countries like US, there is no default. So a lot of consumers actually put zero in their retirement savings. So now in US, companies are moving to a default of 6%, allowing and forcing people to save for retirement. So default options are another great way to force people to actually help them save and invest better. Maybe disclosures. We have lots of disclosure going on in the US, maybe truth in lending, good faith fee estimates. There are lots and lots of programs in the US and Singapore that have come around, which force banks and institutions to disclose. Sometimes these disclosure things can be bad because the institutions may provide irrelevant information. They could provide too much information. They could provide confusing information. So having disclosures, while they are great, like in the US, there is something called a Schumer box that in one page you have to disclose everything about a credit contract. Now, it's great, and they actually have font size requirement for the Schumer box, that you can't just have really tiny fonts. So it's a great way to disclose, but there also institutions will always find loopholes to get around these kind of disclosure requirements. For example, they just might provide irrelevant information, and the consumer doesn't really learn much out of these things. Financial literacy is, I think, something I really am very passionate about. It can help consumers reduce the debt service burden, lowers, if we don't actually have it, it can have adverse effects, can have a lower savings rate. We know there are increased bankruptcy rates, and as soon as we start providing financial literacy, we can undo a lot of these things. We have seen in the U.S., I worked on many programs where we have increased savings rates, reduced bankruptcy rates, increase their investment options, investment choices. So once you actually start making consumers financially literate, over time we see that they increase, or their well-being and their wealth over time will go up. So financial literacy, I believe, is one of the best ways to do this. There are lots of financial literacy education programs on campus for elderly folks. So we can think about an array of programs that we can come up to help everybody. There are programs that will actually help you think about how to do value investments, think about various financial situations, look at your overall financial behavior, and actually study the external factors that may actually help you benefit and do better investments. So I will stop there since I'm out of time, and we'll do the Q&A later.